Hi everyone, I'm Sidney McKinnon, CIO and MD of Cadiz Asset Management, and once again welcome to All Things Fixed Income. Today I'd like to talk to you about a phenomenon called the declining interest rate environment. Now, this is a phenomenon that's been happening very recently, where central bankers, that's bankers across the world, the banks of the governments of the various regions in the world, have embarked on a rate cutting cycle. In other words, they've been bringing rates down. It's a tool that is used by central bankers or monetary policy committees to stimulate economies. And I think we've reached a point in the global environment where various economies, whether you are a developing economy or a developed economy, needs a form of stimulation. So they've embarked on this rate cutting cycle, which means that interest rates are coming down. Most recently, our South African Reserve Bank, which is our central bank, reduced rates by 25 basis points or 0.25%. So what does this actually mean? If you are a borrower, or what does it mean if you are an investor? Now, essentially, if you are a borrower of capital or money, like you've got a home loan or you're paying off your car, this is good news for you because you'll be paying less interest over time because the rate that's set by the central bankers filters down through to the commercial banks, through to the retail banks, and eventually you as the consumer then has to pay back your loan at a specific interest rate. And if this rate is reduced, you will be paying less interest back to the bank or from wherever you borrowed the money. Now, that's good news for a borrower, but for an investor, if you are investing at a specific interest rate right now, and that rate is coming down, you're going to be earning less interest. So is that such a good thing, or is it a bad thing? I know that we're talking about all things fixed income, and I'd like to contain our conversation to the fixed income side of things. And there's various forms and investments that you can make in the fixed income environment that will deliver you an interest rate relevant or related investment return. So on the one hand, you might want to invest in the money market, such as fixed deposits or your bank account or notice deposits. And these type of investments carry a certain interest rate. So most certainly, if interest rates are going to come down or in the process of coming down, it means that you'll be earning less interest on your money. Is it a good thing? Is it a bad thing? Well, I think the important thing to realize here is that even though the interest rate cycle is turning down and you're earning less interest, also what is happening is, as a consequence of inflation reducing or coming down, or the rate of change of inflation coming down, interest rates have come down. So on the one hand, where you're earning less interest, it's kind of negated, not entirely, but maybe reduced, that's a better word, by the fact that inflation has come down. So in other words, what you are paying for goods and services going forward will also come down. So effectively, earning a lesser interest rate does not necessarily mean that your purchasing power has been eroded. It just means that you'll be earning less interest, and also on the other side of the coin, you might be spending less for the services and goods that you will be requiring. Now, that's in the money market environment. An interesting phenomenon or interesting part of the fixed income environment is an investment called bonds, and I've spoken about this before. Now, if you have access to the bond market, bonds actually appreciate in value when interest rates come down. So even though when the interest rates come down, your capital value of your investment appreciates. There's an inverse relationship between the capital value of your bond and the prevailing interest rate at any one particular point in time. And it's a little bit technical, but it involves things like discount rates and your purchasing power and present value and future value, but maybe a topic for another time. But I think the important thing to know here is that if interest rates are coming down and you are invested in a bond, your capital value of your bond appreciates. So, and a very lucrative and also attractive investment in the fixed income environment when interest rates are declining. So, is it a good thing or a bad thing? Or is it detrimental? Or is it a good thing to be involved in the fixed income market when the rates are coming down? Absolutely, because your fixed income investments, the reason, let's put it this way, the reason that you invest in a fixed income investment doesn't change. You are investing because maybe you need liquidity, you need to be able to access your money very quickly, and that's very easily attainable in the fixed income environment. You are investing for diversity. So in other words, this might not be your only asset class. And yes, in a declining interest rate environment, there may be other more attractive or sexy asset classes that could produce you bigger gains at a faster pace. But your fixed income environment allows you to get the benefit of a bond that's appreciating a bond that's appreciating in value. It allows you to be able to manage your risk because generally your fixed income investments are lower risk instruments. And of course you have liquidity and access to all your capital at a very quick turnaround time. So effectively, is it a good thing? Is it a bad thing to be invested when interest rates are coming down? Absolutely. If you are in the market and it's part of your investment strategy and it's part of your diversification, it can only benefit you at the end of the day. So that's my story for today. Thank you for watching. Till next time.